Today's video is brought to you by SD Bullion. Buy your gold and silver from SD Bullion. Right now, new customers can get gold or silver at spot by visiting sdbullion.com/new. All right, welcome everybody. Welcome to another live stream. Seems like it was a big day for gold and silver, for markets in general. A very important day. We heard from the Fed, and Powell has just turned somewhat dovish on us, and you can see that reflected in the price here of gold, now up to spot gold $2,032. So a pretty significant move on the comments that we got from Powell at today's FOMC press conference. Silver also. Silver up about 5% on the day, up to 23.88. A lot of people, when we saw the price of silver dip down earlier this week, price of gold dipping down below 2,000, they were telling me, well, gold and silver, they're going to plummet from here. I don't know. I think maybe the bottom's in. I think that 2,000 is proving to be support. And now that the Fed has gotten dovish in this manner, that basically more money printing is guaranteed in 2024, I think the price of gold and silver are going to be headed much higher. Now, will we see volatility? Yes. Could gold drop back down into the 1900s? Possibly. But again, if it does, I think it'll be met by significant buying. And I suspect that the next rally that we get, the one that brings us over this line right here, just like a couple days ago, we hit 2150 in overnight trading. We spiked above it, but we didn't get a close above the line. But when we finally do, the gold and silver markets are going to be off to the races. Now let's talk about what the Fed was telling us today. This is the story here from Yahoo Finance. Fed dot plot shows central bank will cut interest rates by 0.75% in 2024. Well, I suspect that they may be cutting even more than that. But let's talk about Powell's commentary and let's take a look at the dot plot. So the dot plot here, it gives us an idea of where all the various respondents to the FOMC surveys, all the participants here, what they think the interest rates are headed for in the future. And Powell told us that the median for 2024 end is 4.6%. That's the median of the respondents to the FOMC questions, to where they think rates will be headed. By 2025, the median sees a 3.6% interest rate. By 2026, they're looking at 2.8. So basically, everybody anticipating cuts now. Markets are beginning to price this in. But let's talk about a few of the other things that Powell told us at this meeting. One thing that I thought was pretty amusing was in response to one of the questions, Powell pointed out that the Fed is not political, and the fact that 2024 is an election year will have no bearing on the interest rate decisions. Now, that's pretty rich. The Fed, to be Fed chairman, you get appointed by the president. So really, you're just kind of beholden to whoever is in office. And that means typically you're going to try to help out the incumbent. I mean, that's what we have kind of witnessed so far. And I believe that that is what we will see. If the Fed wasn't political, why wouldn't they comment on the massive deficits that we're seeing? Just last month, we hit a record high deficit for November of $314 billion. And that was a 26% increase year over year. A lot of that has to do with interest rates. So why is it that Powell refuses to comment on this? Well, it's because he is political indeed. And, being divorced from politics means that the Fed really should be able to rein in this kind of government spending, but that is exactly the opposite of what we are witnessing. So it is an election year next year, and I believe that that means that they are going to be doing everything they can to bail out this debt-addicted, failing economy in light of the massive economic slowdown which is on its way. Now, I want to talk about that real quick because there's a lot of signs pointing towards weakness in the U.S. economy. Even Powell mentioned in his talking points here that now, the Fed, they say they have two dual mandates. It's to maintain a strong job market and to maintain price stability. Now, I mean, this is kind of silly on its face because we know that, 2% inflation, that's their target. It's not exactly price stability, and they're far exceeding that in terms of inflation. But now Powell is telling us that he had to focus on the price stability mandate for a while there, because inflation was so high. But now he tells us that the balance of the mandates, it's coming more into balance, which basically means that he's going to have to start looking to support full employment. And that's very likely given the wave of layoffs, which is beginning and likely to continue into 2024. And that's exactly what you would expect in an election year, that the Fed will disregard inflation, which is, far from defeated at this point. And yet it seems to be that the Fed is basically capitulating in their fight, and begin focusing more on jobs, which will probably be more relevant in the short term. And one thing that Powell gets right is that there is some lag between Fed policy and the effects. You can see that here on this chart of the federal funds effective rate. You can see that there were signs of weakness in the U.S. economy as early as 2006, when they paused their previous cycle of rate hikes. Then that weakness began to manifest itself in 2007. They started cutting rates, and yet those rate cuts, as steep as they were, I mean, they ended up cutting all the way down to zero, didn't avert the massive economic crisis. So, there is some lag. Powell says that, and he's correct in that. But the problem is that, we've now got rates higher even than they were in this previous cycle. And the indebtedness, the economic weakness, all the problems that existed in 2008, they still exist. They're much worse. And so even though the Fed now is kind of hitting the brakes here on the rate hikes, it sounds like, and they're starting to pause and certainly talk about cutting, I don't think it's going to be enough. So probably we're going to see rates get cut very significantly as the economy begins to weaken, and as layoffs increase, as all sorts of signs of a recession, a weak consumer. The consumer is driving the majority of GDP. We know the consumer is tapped out. They've got massive amounts of debt, rising levels of default on all of these types of consumer debt. So the economy is going to slow down, and they're going to be cutting in a very big way. They're just beginning to acknowledge that. Let's talk about QT real quick, the quantitative tightening, because this was another thing I thought was interesting that Powell said. He said that he and the other people on the FOMC, they weren't even talking about or considering altering their rate of asset sales. So this is the drawing down of their balance sheet, the quantitative tightening, the selling of U.S. Treasuries on the Fed balance sheet into the market. And he said they're not even talking about slowing this down. Of course, at previous meetings, he had said that they weren't even talking or thinking about cutting. So now they are. And, in the future, probably sometime in 2024, I think he's going to change his tune on QT as well. And they're going to be forced to get back into the market and buy more of these bonds. I mean, just think about it. Look at how little they've really done to normalize their balance sheet. Yeah, he emphasized quite a bit that they've sold off more than $1 trillion worth of these securities. And it's true. I mean, it is down from the peak of nearly $9 trillion to what are they at now? $7.7 trillion on their balance sheet. But I mean, that's still $7.7 trillion. It's still a huge expansion of the Fed balance sheet. And, this chart here, you can kind of tell which way this is going to go. It's going to be just like in 2018, 2019, they were trying to draw down their balance sheet. How'd that work out? I mean, in 2020, they ended up buying something like $4 trillion worth of securities, over $5 trillion over the next couple of years. So I think that we are now in the phase where we're kind of coming to the end of the drawdown. And pretty soon it's going to be like 2020, and we're going to see the Fed coming into the market and buying up lots and lots of government debt. One of the reasons is that the deficit spending is completely out of control, and they're going to run out of buyers for all of this debt. We've seen how big the problem with rising yields on U.S. Treasuries has become for banks, for commercial real estate, for all these sectors of the economy. And think about how much worse all of that would be if the Fed actually were to normalize their balance sheet and sell off $7.8 trillion like what they have left. I mean, it would collapse the whole system. There's no way they can even get it down to pre-pandemic levels without collapsing everything. Things are already starting to show signs of major problems, and they're only this far down. So, of course, they're going to end up coming back into the market. They're going to be buying up more assets. We are going to see economic weakness. It's an election year. They can't let everything fall apart. They're going to pull out all the stops. And when they do, days like today, where you see a 5% jump in the price of silver, well, they're going to become commonplace, I think. In fact, I think that this will probably look tame by comparison. Just look at the technical picture for both gold and silver. When you zoom out to the weekly view, you have this huge cup and handle formation in the long-term chart of silver. You also have a similar formation, an even better one, in the chart for gold. All we need is a close above this line. We saw the line penetrated just a week ago when gold hit its all-time intraday high. Now you've got the Fed basically telling you they're going to be cutting rates, they're going to be printing in 2024. Where do you think gold is going to head? Is it going to, retrace down to the $1,600 level? Well, I guess anything's possible, but I think that the odds are much more likely that we will see a close above the $2,100 level, and then you will see gold heading in relatively short order to the $3,000 level or so. That is what this formation tells us. That would send us to new, closer at least to new real all-time highs for gold. Of course, the real all-time high for gold, if you adjust the previous high for inflation, the high of $850 from 1980, then you get a gold price using the CPI of something like $3,300. So I think that is really where we will be headed. Now, is it going to happen overnight? No. Will it be volatile on the way up? Yeah, probably. I had somebody, though, leave a comment the other day on a video where I said $2,000 gold was cheap. And he said, what are you, crazy? That's near a new all-time high. He said he was going to wait until $200 silver to buy in. Listen, I don't think you're ever going to see gold, an ounce of it, trade for $200 ever again, at least not with the dollar in its current fiat form. I mean, the days of that are over, and much more likely, I think, that we'll get $10,000 gold than $200 gold, because, that would be kind of a same order of magnitude move. And I really think that, $10,000, $20,000 gold, much more likely than $200 gold. Let me know what you think in the comments down below. Give me a 1 if you think $200 gold is more likely. Give me a 2 if you think $10,000 gold is more likely, because really, you got to remember, when the Fed begins printing again, it's going to devalue the currency. That is what printing does. And the ultimate high for gold priced in dollars really is it's infinite, because the bottom for the dollar, it's a fiat currency, is zero. The dollar's been around in its current form for more than 50 years. 1971, that's when it became a purely fiat currency backed up by nothing. So, if you know of any fiat currency, purely fiat currency, that has been around for, say, a century or two, even that long, without massive devaluation, a historical example of that, put it in the chat, put it in the comments down below if you're watching this later, because I don't think there's a single one. And, this time around, it's not going to be any different than what we have seen throughout history. Let's take a look at the chart of the CPI. So the CPI is coming down, allegedly. That's what we hear from the government numbers. It seems like everything continues to get more expensive to me. And of course, that is what this chart tells us, because it's not like, when they say inflation is coming down, that doesn't mean prices are coming down. That just means that prices are moving up at a slower pace. And because this is a cumulative phenomenon. Thank you very much for that, Jeff, by the way. He just gifted a bunch of memberships to people. Thank you all very much for the support. Jeff is a great member, and he is really doing a lot to help support this information, support the channel. I really appreciate it. Do me a favor, if you're watching, Super Chats, always super appreciated. But the best thing you can really do to support this channel is hit the like button, subscribe to the channel, and share this video on social media and with your friends. Share it with people you don't know. Share it all around, because more people need to get prepared for what is coming, because it is going to be massive dollar devaluation. So this chart of the CPI, I suspect that we may see this begin to tick back up. Now, it really just depends on how bad the economy begins to suffer in 2024, because it could be that we see inflation decline in the event of a major deflationary collapse. That's always possible. Just like in 2008, we actually got a little bit of deflation. You can see that the CPI, this is the year-over-year rate of change, the CPI actually going down. So, we could even go into negative territory depending on how bad this collapses and how hard the Fed works to get ahead of it. But you got to understand, if that happens, that will be a huge blow to this debt-based economy where they need the constant inflation of the money supply and the constant creation of new debt. If we get a crisis of that magnitude, the Fed response will have to proportionately be so large that ultimately the CPI and inflation in real terms, not necessarily as measured by government numbers. I don't know what they're going to do with the CPI if inflation really gets out of control. I mean, expect all sorts of tricks and manipulation and data massaging and, perhaps just outright fake information at some point if we're not even already there. But ultimately, the real rate of inflation and the devaluation of the currency is going to be phenomenal because, as I said, all of the problems from the previous crises still exist, plus all of the additional spending and debt that the federal government has taken on, that every entity has taken on, from consumers to corporations to businesses. Everybody is up to their eyeballs in debt. And the only way to resolve that problem is to devalue the currency. I mean, the U.S. government has over $200 trillion in unfunded liabilities. How do you pay that? Well, there's not enough wealth to tax, so you have to devalue the currency. It's the only way. Someone in the chat here, Rolf Steiner, says Dow 50,000. Yeah, very possibly. So let's talk about that. Let's talk about the Dow. We had the Dow hit an all-time high today. This is a long-term chart of the Dow Jones Industrial Average, and you can see that now at all-time highs. And look, I mean, if the Fed starts printing stocks, paper assets, all sorts of things could get inflated. Real estate could be driven up if they create enough money. The money's got to flow into some kind of an asset, paper assets too. But ultimately, this time around, what will be different is that they're going to be printing when inflation is already a problem. The core CPI already at 4%, probably going to be heading a lot higher once they begin printing. And now that markets are anticipating all of this printing, I mean, that alone could be enough to drive inflation. But imagine when they actually return to the printing presses, and when they actually, this will probably be the big one, when they return to QE. That'll be a sign that the dollar is really done for. But this isn't the chart you need to be looking at. The chart you want to look at in regards to the Dow and stocks is this one right here, the Dow to gold ratio, because this is the pricing of stocks in real money, right? This is not how stocks are priced in dollars. This is stocks priced in gold. And even if the Dow Jones in dollar terms goes much higher, I believe we will see the price of gold moving at a much faster pace, and especially silver even more so. But let's just talk about gold for now. And you can see that on two previous occasions in the past 100 years, the Dow to gold ratio has gone down below 2. One was in 1933 as the Depression had created that huge decline in the price of paper assets. So you had a deflationary collapse. And of course, gold was pegged at $35 an ounce back then. But then also the massively inflationary decade of the 1970s. If you see here in 1971, if you wanted to buy a share of the Dow, you would have to spend 22 ounces of gold. By 1980, that got down to 1.4. So priced in gold, stocks got very cheap running from 1971 to 1980, even though their nominal price was moving higher. So look, there probably will be a time to get into paper assets. There probably will be a time to get into stocks, to liquidate gold and to move into those. But right now, gold is the cheap asset. I mean, right now, a share of the Dow is around 17, 18 ounces. So it's very similar to the setup that we saw back in 1971. You buy an ounce of gold now. When the price of gold explodes, you'll be able to liquidate that and get stocks on the cheap. Now, that's not financial advice. I'm not even telling you that that's what I plan on doing. I mean, it's just one potential scenario. There will be a time to get out of gold. I mean, it's not something you sit in indefinitely, but valued against other assets, I believe that the price of gold is going to be moving a lot faster. And so, now I think is the time to be getting into gold and silver. So that's what I'm stacking. I'm not going out there and buying shares of AMD or Nvidia or AI stocks or Apple. I'm just trying to pick up and accumulate more hard assets outside of the financial system that can't be inflated, that don't have the counterparty risk. I mean, they kind of prepare you for a variety of scenarios that could play out here because nobody knows exactly how this is going to play out. But ultimately, one of the things I know, we're going to have more debt. We're going to have more dollar devaluation. I mean, just look at the chart of the CPI. So this is the chart. Let's see if I can switch to that chart. I'm having a little trouble here. Anyway, the CPI, I mean, the rate of change, we always focus on that, the pace at which the rate of inflation is changing. But the one thing about the CPI is that, I mean, it's always moving up, right? It's just a matter of how fast is it moving up. But inflation is basically always on the rise. And so that's why, back in 1971, an ounce of gold went for, $35, and now it's over 2,000. Okay, I seem to have returned to the ability to change tabs here. What I wanted to show you was, instead of looking at the monthly rate of change for the CPI, you just look at the index itself. And I mean, that gives you an idea of where we're headed. It's basically always baked into the cake that the dollar is going to be devalued. The higher this goes, the higher the cost of living goes. You can see, I mean, it's kind of moving at a faster pace here. And I suspect that when the Fed really begins printing again, this chart is going to go exponential. So that's pretty much it for today. If you think the price action in gold and silver today was significant, just wait until the Fed begins printing in earnest, because right now the only thing that is driving this price action is the anticipation of the printing. And from what they're telling us, they are going to be cutting rates, but I think the reality of it is they're going to cut even faster than what they're telling us now. And even though Powell tells us that he and the other members of the FOMC, they're not even talking about, changing the pace of their asset sales, they are. I mean, they're certainly considering this. I think he understands that the banks are largely insolvent. One of the only ways to solve that problem is to get interest rates down. And one of the best ways for the Fed to drive the yield on treasuries down is to buy a lot of them. I mean, they don't have that many tools over at the Fed. They basically have the federal funds rate, and then they've got direct market operations where they can go in and buy things. And in the past, they have shown no hesitancy to use both in the event of economic crises, and that's exactly what we're heading for. It's a perfect storm. It's an election year. They can't let the bottom fall out of the market, so they're going to print a lot. Let me know what you think in the comments down below. Stay safe and happy stacking, everybody. I will catch you next